All my beautiful apes and apettes, yes, I am talking about you. You look great today. Baby, we have some big announcements to go over. A huge win for AMC stock and helps to confirm everything that I have been saying. And I'm going to try to break this down like you guys are 15 and know little of nothing about anything, which I know you guys do, but I'm just going to break this all down pretty simple for you guys. So let's get into it. Hit the like button, do what you guys got to do. Subscribe to the channel as well. Not important. Let's talk about what is going on with AMC today. First and foremost, we were up over 1.5%, now down 1.67%. We were down lower than that in the beginning of trading, down under $20 per share to $19.51 was the lowest point. We're currently trading at $20.32 per share. Okay, you guys get that. You probably looked at the chart. So what is actually going on today is we are getting the bank earnings, what I have been talking about, and they're not coming in so hot. Take a look at this. JP Morgan shares fall 5% after CFO lowers guidance on headwinds, including wage inflation. It's not bank earnings. Why AMC just got a big win. We must go over the banks first and what happened to give you guys the context, and then go over why this is such a big win. Because meets the eye, you're like, okay, banks, their stock fell, nothing too crazy. But this is actually very important. So the key points. CFO Jeremy Barnum told reporters on a conference call that management expected headwinds of higher expenses and moderating Wall Street revenue to cause the company's returns to dip from recent years. That is likely the bank will miss the firm's 17% target for returns on capital, he said. When asked if a tight labor market was forcing JPM to pay its personnel more, Barnum had this response. In quotes, it is true that labor markets are tight, that there is a little bit of labor inflation, and it's important for us to attract and retain the best talent. So there's that. Let's talk about the other bank earnings. Wells Fargo, not too much, nothing too crazy to go over there. They did just top estimates, and their earnings call, it does not come out here for about another hour. So that's when you get the questions and you start to get more of the headlines coming in. Quarterly reports are just pretty much the numbers, nothing too crazy. It's the earnings calls. You get that context behind what's going on and that guidance. That's what investors are looking forward to the most, is the guidance. Take a look at this though. Citigroup shares slide after fourth quarter profit declines 26%. The company's net income dropped 26% to $3.2 billion. Citigroup cited an increase in expenses for the sharp decline. Citigroup reported an 18% year-over-year rise in operating expenses to $13.5 billion for the quarter. Now, what is going to be really important, check this out. Retail sales dropped 1.9% in December as higher prices caused customers to curb spending. Retail sales declined 1.9% in December, much worse than the forecast for a 0.1% drop. Weak online sales were responsible for much of the slide, along a fall in spending at bars and restaurants. Imported prices declined on the month, the first decrease since August of last year. So they were expected to only go down 0.1%, but they went down 1.9%, which is a massive beat to the downside, right? So not good, not good. And what have I been saying on this channel? What have I been saying? If you guys watch all of these videos, you already know, and you know why this is such good news, because I have been talking about what's really going to cause the MOASS, what some people don't fully get, and I'm talking content creators out there that are spreading information, is that the MOASS does not happen until liquidity is restricted. A slowdown in spending will cause a recession over time. So we're going to be comparing 2020, 2021 numbers where we had a bunch of stimulus to our numbers in 2022, which are going to look substantially smaller. And the markets right now, they are pricing in higher earnings growth for 2022. So it doesn't look like that is going to happen. And I pretty much knew this was coming. So if you guys are on the live streams, if you may or may not know this, some of you guys probably do, some of you guys probably don't, but I'm a real estate agent. I own rental properties. I also work at a restaurant. I've worked there for years, and I actually work there with my mom. It's a higher end restaurant, but nevertheless still a restaurant, and I work there with my mom. And then YouTube, right? So I work at the restaurant 4 to 5 days a week, and we have noticed a substantial decline of people coming in and getting food. So I've seen the spending has already started to slow down, but this spending slowing down is not going to be reported here on this earnings because it was literally like crazy. The day after Christmas, well, like 2 days after Christmas, sales dropped dramatically, like 60% declines in sales and the number of people that are coming in. And you're likely seeing this everywhere as people have a lot less money and they're also not spending as much. This is showing you that, the Christmas sales might not be as good as expected. I still think they're going to be decent. And that's why I do think this earnings season, right, for Q4 2021 is going to be decent. I don't think it's going to give us real big headwinds in the marketplace unless companies magically just start missing earnings left and right. That's going to obviously reduce liquidity and get us closer to the end game, closer to the MOASS. But it's going to be Q1 2021 for January, February, and March that are going to be the most important because that's going to be the first quarter of no stimulus. We are going to get taxes coming back, but no stimulus and spending that has slowed down. So that's going to be most important. And I think by the second quarter earnings season, you're going to see a dramatic decline in stock prices, and you're naturally going to see that liquidity being drained. So then once you start to see pops with AMC, 20% moves in a day, you're going to start to see shorts getting margin called, intraday margin called, and they're not going to have as much money to service those margin loans. So that's the situation. That is why this is such a big win, confirming that spending is slowing down. Like I've been saying, liquidity will be severely restricted in the second half of 2022. So this is all coming to a boiling point very, very shortly. I am certainly not a financial advisor, but I am buying more AMC at the current moment, as a lot of institution and hedge fund investors are as well. Really around $20 per share, they are loading up the boat, and we're seeing a lot of support around $20 per share, now down about 2.3%, but I don't even care what happens on the day-to-day until liquidity is actually restricted and we are prone for the MOASS. I really don't care what happens, and I know you guys don't either. So that's a great mindset to have, and you'll make a lot of money with that exact mindset. Now, let's get into some of the other data that you guys need to know. Watch the $20 level just, for that support level. If we, for whatever reason, flush under that, watch $18.50, but I don't think we're going to. I think we're going to dip down and then see another bounce and kind of level out just above $20 per share. Only my prediction, my foresight, take it for what it is. As far as the Ortex data, let's refresh the page. We are looking at 19.13% short interest of free float with a share utilization of 75.34%. Days to cover 2.45. Estimated shares that are sold short of 98.21 million. Cost to borrow pretty much the same. A lot of these numbers are not moving around all too much lately. Now, as far as the stock O tracker data, we know this big expiration is next week, by next Friday, which is good because the Fed FOMC meetings is not until Tuesday and Wednesday of the following week. So we do have that whole next week without a big catalyst. We are going to have earnings, and that's going to be the main focus for investors, is seeing how well did companies do and how well are they going to guide. So that could give us a boost to the upside if guidance is good, if earnings are good here in the short term, and could give us the next leg up into really that $30-$40 range. Could be possible next week if a lot of these options do go into money, because by all means, we're looking at 630,000 calls that are out of the money, 63,000 alone at the $40 strike, and about 88,000 calls that are in the money, comparatively to put with 115,000 that are in the money, 280,000 that are out of the money. So a big difference relative to calls and puts, and that could get very exciting if we do see that move to the upside. That is pretty much all you guys need to know. As far as the max pain is concerned, take it for what it is, because it is obviously Friday, and the max pain is at $23 per share. Don't exactly think we're going to go up 7, 8, 9% today, but it's possible. Keep that in mind. Max pain $23 per share. So love and appreciate you guys. Thank you for watching. I will see you in the next one.